Welcome to Short View Trading. This is your morning market hit for Friday, 10th of December. What matters today for traders? Well, it's been an interesting week in markets. At the back end of last week, you can see equities found a floor with the S&P testing and holding above its 50 and 90-day moving averages. And then this week, we rallied sharply from those levels and back within November's consolidation range. Other indices also held above key levels. The Russell 2000, for example, tested and rallied from its technical support level, which has held nicely since late February. And encouragingly for the equity market bulls, there have been signs that fears around tight liquidity in markets have been easing. You can see, for example, high yield credit spreads in the US widened sharply in late November. The scale on this chart is inverted. And then as equities rallied this week, spreads narrowed, confirming the risk on move. And generally, fear in markets was priced out. You can see that in the VIX, peaking last Friday at little over 35% intraday. Yesterday it closed at 21%. So does the VIX have further to fall? Is it going back to its October lows of around 15%? Or put another way, is this equity market about to push higher and rally through to year end? We answer all of that in our daily trading publication. In it, we make a 1 to 2 week recommendation, long or short, on US equity futures. It's available on our website to subscribers. We also offer a free trial for 7 trading days. If you're interested, click on the link below, enter your name, email address, no credit card details required, and we'll send you our daily trading publication free for 7 trading days. This week, we've been recommending long positions in the US equity market, reflecting a number of buy signals that we've had from our short-term indicators, like this one you see on your screen now. This is the 3-day smoothed put to call ratio. It's recently been on strong buy, illustrating the high levels of downside put protection in portfolios and telling us that there's plenty of fear and panic in the near term in markets. And you can see this indicator still on buy, pointing to further upside in equities. On that basis, the outlook for equity markets is pretty encouraging. There are, though, a number of risks, not least including today's US inflation report for November. If that surprises to the upside, equity markets will probably respond negatively. Of course, that would add to the case for more hawkish language at next week's Fed announcement and press conference. Having said that, short-term interest rates and bond yields have been backing up quite sharply in recent trading days. You can see that from US 2-year bond yields. Arguably, that's in anticipation of high inflation and a hawkish Fed. So that risk is likely already priced in. For how we're trading this market, have a look at today's daily publication. What are we watching today? Well, aside from US inflation, we get the first estimate for December for the University of Michigan sentiment. We've also got a number of speeches from ECB policymakers, including Weidman, Lagarde, Bill Roy. That was your morning market hit. Do follow us on YouTube, search under Short View Trading. Join us on Twitter, LinkedIn, and or Facebook. Thanks for listening.